So the bubble here, again, to go back to the things I was talking about in the first video, economic bubbles are based on some irrational belief. The irrational belief here was that house prices would keep going up, and therefore the defaults on the subprime mortgages that are the more risky mortgages wouldn't matter, because the people who default on subprime mortgages would lose their property, the bank would take over the property, but the bank would be able to sell the property for more than they gave in the mortgage. So the bank is protecting its assets, so to speak. However, if the prices of houses did not keep going up, this thing stops working. And essentially that's what happened. You can see the problem here, that the problem that the banks had in having moved to this, develop these new sophisticated investment products, they needed to recycle the money more and more and more quickly. They needed to push the money out the door, get more people to take out loans so that they could turn over the money again. And that has to mean that you have to force the money, almost force the money, on people who are less reliable, who are riskier, who have perhaps no assets at all. There was not entirely a joke among estate agents in certainly even in the UK, in London, sometime in the 90s, that people with no assets and no possibility, no jobs were being almost forced to have mortgages, because the banks would just give you a mortgage for almost coming in the door and say, I would like to borrow money. They would say, okay, how much do you want? And that does, in some, I mean, this is, I suppose, perhaps not exactly true, but it does express the notion that the banks had to keep recycling the money. Now, I suppose something I should say here about the irrational bubble is that the people, again, I think the satirical videos, I put those on the website for a particular reason, even though they are rather satirical. They have got some really good information in there. And one of the good bits of information that they say when one of the, I can't remember whether it's which one it is, asking the other about did everybody in the market believe that believe in these SIVs and CDOs and so on? And the other guy says, well, no, they didn't. And what happens here is that everybody understood that at some stage, at some time, house prices would have to stop going up. But all the actors in the market basically believed that they could get out, they'd be stopped holding these assets before that happened. That I held this SIVs, the house price is still going off, I could sell them on before anything happened. And of course, it's pretty impossible to predict in advance when the thing is going to reverse. And that's essentially, I mean, that's the essence of practically all economic bubbles. And so, that's why, even though with hindsight, it seems absolutely daft that that's what's driving this bubble in the banking system. In the 1990s, it wouldn't have seemed that unsensible, because everybody says, yeah, we know in principle that house prices can't keep going up forever, but we also know that we're clever enough not to be holding these assets when they actually stop going up. We'll have got out of the market by then. Of course, that didn't actually happen. Well, that's not quite true. It didn't actually happen. It happened for a few big investors, but mostly it didn't. Now, one of the last thing on this slide that I'm trying to explain is the difference between this market crash, this banking crash in 2007, and the last huge globalized sort of economic event, which was the Wall Street crash in the 20s. The big difference here is that the financial market, was far more globalized, interconnected in 2007 than it was in 1920. If it was possible to think of subprime mortgages having happened in the United States in 1920 and the market fell over, it would have had very little effect on banking in the UK and in Europe and Japan and Australia, because the banks weren't connected. For example, to go back to one of the cores of the problem you're wrestling with here, Northern Rock, the foundation for a lot of their lending was operations in the money markets. And effectively, they were borrowing money which was in some fundamental way sort of based on subprime mortgages that were sold in the United States. So, I mean, this seems like an odd thing to happen, that a bank in the north of England was affected by an economic change that happened basically in the southern United States. But because it's a globalized market, that happened, and it happened very fast. So the market became globalized because of the deregulation in the 1980s. One of the reasons that the speed of events happened was so rapid was because of electronic transfer of funds. Basically, all banks move stuff around on computers these days. I mean, all these numbers are just numbers in databases. So it happens instantly. And those worldwide trading SIVs, securitized investment vehicles, and CDOs, credit default swaps, those sort of stuff. And market sentiment, again, as the strategic videos say, when they're talking about markets, that the way markets work depends on market sentiment. Sorry, I'll say this word properly eventually. Sentiment. What we mean by that is that it's a belief in how what's going to happen. Basically, until the market crash, all the operators and the investment banks and the big market operators believe that these structured investment vehicles, these very complex financial instruments, were actually based on some real assets and would hold their value. Very, very quickly, all these people came to believe that these things were not based on any reliable real assets and were worthless. And that's the thing, that's what caused the market sentiment to turn very quickly. Okay, so the bubble burst. And the thing to understand here when you're analysing this bigger problem is that it's different to former economic bubbles because the difference in speed of the effect. Former bubbles had limited effect on the wider economy. But this banking crisis had a global impact, and the crash happened very quickly. So essentially, the problem is focusing on, I suppose, the events of Northern Rock, but that is simply almost a symbolic representation of the whole banking system and how it works. So again, I urge you to look at the videos by Professor John Kay, because particularly, I mean, his first video probably explains more clearly than I have the reasons behind what happened to the banks in 2007. But his second video is very useful because it actually goes on to suggest how we might avoid these things in the future. And indeed, for your problem, that's one of the really important things you need to look at.